What's up everyone? Another tax video. Today we're going to be discussing personal use property. We'll be covering LPP gains and losses. First, some key provisions. So please recall from your lecture the following key provisions. ITA 54 is where you go to define personal use property and listed personal property. ITA 40 subsection 2 paragraph G subparagraph 3. It disallows losses on personal use property. ITA 41 subsection 1. That talks about how a taxable net gain is 1/2 of what is calculated in ITA 41 subsection 2. That's another example of how something is 1/2 of the 100% amount when the word taxable is used. This happens in subdivision C when we deal with taxable net gains and taxable capital gains. Speaking of ITA 41 subsection 2, ITA 41 subsection 2 explains what a net gain is, and that is your LPP or listed personal property gains, subtract your LPP losses, and from that we subtract any LPP loss carryovers. And then ITA 41 subsection 3 goes into more detail and explains a listed personal property loss. The other key provisions with respect to this topic takes us back to the nitp aggregating formula we find in section 3. Specifically, we are going to focus in on ITA 3b. And if you recall ITA 3b, it says a lot of things, but we didn't go through it all at the beginning of the term. Well, now it's time to do that. So ITA 3b, it says determine the amount, if any, by which, subparagraph 1, the total of, clause big A, all of the taxpayer's taxable capital gains for the year from dispositions of property other than listed personal property. What does that mean? Well, I'll highlight this, other than listed personal property. This is what you're used to calculating. This is the TCG on all capital property except listed personal property. After this, we have clause big B, the taxpayer's taxable net gain for the year from dispositions of listed personal property. We can highlight some of the key terms here. The taxable net gain from dispositions of listed personal property. This is referring to essentially a formula. Now, the word taxable that's highlighted here under big B is referring to the 1/2 inclusion rate. Net gain is referring to the rest of this in brackets. LPP gains subtract LPP losses for the year, then subtract any LPP carryovers from another year. And you'll recall the rest of this. By how much does all of this exceed subparagraph 2? And subparagraph 2 is where we talk about allowable capital losses from the dispositions of property other than listed personal property, because that was dealt with above. And by how much does that exceed our allowable business investment losses for the year? Okay, that's enough of a preamble. You've got questions, we've got answers. Let's go! This is question 2 of the lab. Let's go through it. After a lengthy career as a successful stock market analyst, Ross Howard's lost his job. He is having trouble finding new employment, and in order to make ends meet, has begun to sell some of his prized possessions. Oh no! Fictional Ross Howards, don't let this get you down. You know what? This is a good time to pause and reflect. All of us. Don't define yourself by your job or your career or your car or your house or your awesome hat, things like that. Those are externalities. Really, you need to reflect and define yourself from within. That's where the inner joy and peace truly comes from. Fictional Ross Howards, I want you to say to yourself that I am lovable, capable, and self-confident. Lovable, capable, and self-confident. You can get through this, fictional Ross Howards. The following transactions occur during the current year. His beloved collection of limited edition glittered lapel brooches. Okay, quick interjection. A lapel is like this pin thing that some people will wear to, I don't know, make themselves look fancy, you know, elitist. Same thing with the brooch. It's pronounced brooch, even though it looks like brooch. I don't know. I think I had to do a spell check on it, but apparently that's how it's spelled. And yeah, some people, if you can believe it, think that wearing something else specifically makes them, look better or more special. Like, if you can believe such a thing. Yeah. Had a total cost of 42,000. However, the proceeds from their sale to another collector amounted to only 13,000. He always wore multiple pins on his jackets and shirts in order to impress clients. His first edition of his favorite novel, Hemingway The Sun Also Rises, had cost 12,000 and sold for 31,000. He'd inherited a small Paul Bourdois painting from his grandfather. The painting cost his grandfather $1,500. At the time of the bequest, its fair market value had increased to $128,000. It is sold privately by Mr. Howard for $132,000. For several years, he has driven a Bentley Flying Spur, which cost $185,000. It is sold for $64,000. His antique Chris Craft race boat had cost $45,000 several years ago. It is sold for $62,000. Not bad. Indicate the tax consequences of each of these dispositions using the proper Section 3 format for 3B. So you don't need to do it for the whole thing. It's got to be proper formatting for ITA 3B. In addition, indicate the total amount that will be included in Mr. Howard's NITP and any carryover amounts that are available. Let's answer this, and let's keep ITA 3B on the screen to help us put things in the right spot. So we can start off by acknowledging that all of the items sold are personal use property, but only some of these items are listed personal property. The pins, the painting, and that first edition book, those all are clearly listed personal property. The Bentley and the Chris Craft, those are not listed personal property. So now we can start to put things in the right spot. We can begin with the gain on the boat, which was 62,000 minus the cost of 45 times 1/2. It's $8,500. Again, we deal with that in 3B subparagraph 1, big A, because that is not listed personal property. Then we can move on to the LPP items. And we have some gains on a few different things. There's the first edition book, 31,000 minus 12,000 for $19,000. And then we can take a look at the gain on the painting, which was 132, value of 128 at the time of bequest, for a gain of 4,000. Our total LPP gain then is 23,000, and the loss on the pins was 29,000. If we total this up, we get an LPP loss of 6,000. The taxable net gain for our purposes here is going to be $8,500. The most of this loss that we can actually take is 23,000. We can't take the entire loss because this here cannot be a negative amount. Now finally, we deal with the loss on the Bentley. It's going to be no loss on the Bentley because it's personal use property. In order to be considered depreciable property, it's got to be used for the purpose of earning income. And this Bentley isn't used for that. So this Bentley, the loss is denied because it's personal use property. Now, we haven't quite answered this entire question, nor have we addressed the requirement. The requirement asked us to use proper Section 3 formatting. So let's make some space and do that. The gain on the boat should be labeled as being 3B subparagraph 1 big A. The gains and losses with respect to LPP should be labeled as 3B subparagraph 1 big B. And then the loss on the Bentley is 3B subparagraph 2. So the amount that is going to impact NITP would be a taxable capital gain of $8,500. But we're still not done yet. Remember that $6,000 loss kind of in the middle of our calculation? We need to identify what that is. And that $6,000 should be noted somewhere in your answer that is an LPP loss carryover. I hope that was helpful to you, and I hope you were able to follow everything. And so until next time, thanks so much for watching.